Hello, Houston. Welcome once again to On the Money with the founder of Allied Wealth, Ryan Wheless. I'm your host, Spike Spangle. Ryan, it is great to see you. We're jumping right into it today.
Well, we got in a little spirited conversation last night at dinner, bud.
Yes.
And so we got to bring it to the air.
It had
folks.
nothing to do with the adult beverages that were served.
Well, none at all. They were tasty.
Yes, indeed. But I've come from a different school of thought when it comes to financial services. I've been in the industry for a while. You've been in it a lot longer. You've got a successful practice in Allied Wealth, offices all around Houston. But I started out where annuities were a bad thing. And please don't change the channel, folks. We want to talk about annuities today. In fact, we're going to have the most frank conversation perhaps you've ever heard on television or radio about annuities, because I don't always necessarily agree with you on these. And I want you to convince me on annuities.
Well, a man convinced against his will is of the same opinion still. So we got to it's a balancing act, right? So I'll give it my best. All right. Best foot forward. Spike, it's one of these things where there's so many people that don't like annuities, and there's so many people that offer annuities. In fact, folks, you have a 9 out of 10 chance of being offered an annuity when you sit down and talk to a financial advisor in today's world. The funny thing about that, though, is it takes less time in the state of Texas to become a financial advisor than it does to become a massage therapist or a beautician. All right, so it's a line you got to walk.
But are all financial advisors equal?
No.
There's just a lot of people use that phrase. So legally, there isn't a specific definition of somebody who has to call themselves a financial advisor. So I'm saying somebody who only has a life and health license can call themselves a financial advisor, but they can't manage assets as well.
That's right.
So how do we know, how does the audience know who they're working with?
It's really simple. You ask your advisor, are you a fiduciary? All right. And then you ask for references. Does the advisor have references, existing clients you can talk to find out how that advisor has served and the investment recommendations have worked out from their existing client base? It's a great way to do it.
All right. Well, one of my first objections on annuities, should we start with fees or illiquidity, or they're inappropriate for somebody who isn't managing
they're
money?
All bad.
Yeah, they're all bad, all across the board. They're usually considered a 4-letter word.
Yeah. Well, the thing I have to ask you, though, is that, like, if you tell me annuities are bad or an annuity is bad, which annuity specifically are you talking about, Spike?
You've hit the nail on the head for me, because I get a bit confused by which ones they are. And so if I'm thinking of our viewing audience out there as well, how do we know what kind of annuity to search for?
Well, that's what the opponents of annuities want you to think, by the way. That's because there's 4 types, they're very complicated. And they really aren't complicated at all once you get a clear understanding of them. So you have 4 basic types. You have an immediate annuity. The key word with an immediate annuity is a pension. You exchange a lump sum of cash to an insurance company in exchange for a monthly payment you can never outlive. All right? So if you live to be 115 years of age, that insurance company has to pay you that monthly payment as long as you have breath in your body. However, if you step off the curb 2 years later and get hit by the bus, guess what happens, folks? The insurance company keeps all of your money and the payments stop. So this is the old adage of, I don't want to buy an annuity, Ryan, because if I do, the insurance company keeps my money if I die.
I've heard that. In fact, I can remember somebody yelling at a seminar, screaming from the back of the room, no, if you die, they keep all of your money.
And guess what?
True of all annuities?
That is not true of all annuities. Yet, we try to lump things, the opponents of annuities try to lump all this stuff in to make them look really bad, right? And the reality is you have to get educated, unpack what they do and what they are for yourself, and ultimately make the decision for yourself, folks, because you're responsible for funding and investing for your own retirement. All right? That's the way it works.
Because I think the number one thing when people go into your offices is they want to know, am I going to be okay? Am I going to outlive my money?
Well,
So immediate can be something like, I retire, I take money from my 401k, and I want to make sure that I'm not running out of... Now, do I have to do it immediately?
No, you can defer it out 5 years, 10 years, start income in 5 or 10 years. But Spike, more importantly, annuities are like the Honda Accord. All right?
All right, where's this going?
Okay, well, the first Honda Accord from Japan was a piece of junk. Okay? But now the Honda Accord and the Toyota Camry, for that matter, they're phenomenal vehicles. I mean, they have 500,000 miles in some of these cars, right? Annuities are the same way. They've evolved tremendously. So there are programs out there that allow you to have guaranteed income for life. okay, that pays you as long as you have breath in your body. And if you die, any remaining balance passes to your beneficiaries. No questions asked.
Okay, but that is not the immediate.
That's
there
not
are
the
other
immediate.
versions.
That's exactly right.
Just like the Ford Model T, we've come a long way since then. So there are different kinds out there. So what would you explain then next if we get outside of immediate?
The next one that really puts a black eye to the annuities in general is what's called a variable annuity. And at Allied Wealth, we call that a scariable don't do-ity. And the reason why, folks, is, Ken Fisher's got a commercial out talking about how he'd rather burn into HE double hockey sticks than sell someone an annuity. And what he's talking about is a variable annuity. And his argument is you can't do anything inside of a variable annuity that you can't do outside of a variable annuity for much less in fees and costs. And he is exactly right, by the way. He is exactly right. So what happens in a variable annuity is you put $100,000 in the annuity, all right? And the insurance company that has the money is investing your money in mutual fund sub-accounts. Those sub-accounts have risk, okay? And what they do is they insure your initial deposit against potential losses in those mutual funds. So if those mutual funds drop your account balance from $100,000 to $60,000, so we're down 40%, right? Your beneficiaries are guaranteed to get no less than what you put into the contract. So if you die, your beneficiaries get the $100,000 you put in. Here's the problem. Most of the clients that I serve at Allied Wealth and my team serve at Allied Wealth are trying to figure out how to live the best possible life they can with the resources they have to work with. They're not trying to figure out how to die, right? And to get that benefit, you got to die, and that sucks.
And it's one of the only benefits of the variable itself is that at least you get what you put in. The other negatives, when we talk about fees, really high fees. So this is a fee structure inside.
The variable annuity has, on average, on the low side, 3%, and I've seen as high as 6% in fees.
Now, real quick though, these aren't fees that necessarily come out of my pocket.
Yes.
So I will pay that, like as a monthly or an annual basis?
Oh, yes, absolutely. So here's the way it works. The life insurance component I just talked about, we're insuring your account against market losses, is a mortality and expense charge, 1 to 1.5%. Then we can enhance that mortality and expense charge and have that death benefit increase each year. That's another 1% in some cases. Okay, so now we're at 2.5% in fees. The mutual funds inside of the variable annuity have an average fee of 1%. Now we're at 3 to 3.5%, and they have these guaranteed minimum income riders, okay, where you can get guaranteed withdrawal benefits out of these programs. Those fees are running another 0.5 to 0.8%. So we're already at 3.5 to 4% in fees in this program. And they all have similar programs and do the same thing to where they put your money at risk, all right? If you die, there's a death benefit. But folks, you take all the risk and you pay all the fees.
How does somebody at home know whether they have a variable? I mean, does it say variable annuity on the top of their contract?
If
do they know what
bought
kind?
It from a big box retail company or a bank, it's a variable annuity. And it will say it on top of your statement, by the way. It's required to.
We do have to take a very short break right now. We want to continue talking about it.
Yeah, folks, listen, we're talking about annuities in detail today because so many people are just scared to talk about them. They're afraid that you're going to turn off the television and not listen. But you want to stay tuned into the show because we're going to show you some very, very important things about these programs and how they can save you in the current rising rate environment. Further, we're offering a copy of a book called Stress-Free Retirement. To get Stress-Free Retirement book, all you got to do is call us at 844-944-7555. You can click the QR code at the bottom of the screen. Again, the number is 844-944-7555 to get your copy of Stress-Free Retirement.
We're going to come back with more talk about annuities, but get your complimentary copy of Stress-Free Retirement by calling the phone number right here, 844-944-7555. Also use that phone number, though, if you know that you want to get a review on what you might already have. Do you have a variable annuity? Do you know what you're using? Give us a call. We'll do a complimentary second opinion as well. More On the Money with Ryan Wheless right after this.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only. to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have. By running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Welcome back to On the Money with Ryan Wheless. He is the founder of Allied Wealth right here in Houston. We are having a very frank discussion today about annuities. Please don't change the channel. It's very, very important. We're having the kind of discussion that I think that most people will normally avoid on television, will avoid on radio, and sometimes even avoid in person.
To that end, Spike, you are that person. You're skeptical. The whole impetus of this
I've been the
show
skeptic on
is
them.
our spirited conversation last night at dinner, right?
Right.
And, you know, we mentioned something in going to the break. I don't want to give the watchers of our show, our audience, the opinion that all we do is annuities and Allied Wealth, because we don't. We're a full-service firm. We do money management from the top level down. We offer every product we can under the sun. What it really comes down to, though, is what are you comfortable investing your money in? What are you trying to accomplish? And can we build a plan, including products, to help you accomplish that?
Right.
That's what it comes down to. So, folks, we've got people that hate annuities. That's great. If that's you, don't buy one. We've got people that love annuities. Great. They don't want to be in the market. That's great. The bottom line, though, is the biggest thing that we see when we talk to annuities about people is they simply don't know what they don't know.
Well, because you just said it. People hate annuities. How can you hate something if you don't understand how it works?
It's a mind-boggling. Well, it's because, you know, it's the nightly news guy puts it in your ear that annuities are bad. Ken Fisher puts it in your ear that annuities are bad. And the reality is there's actually, 5 different types of annuities, but which one's bad? Right? If I had a fixed annuity right now that guaranteed a 15% interest rate, would you buy it? Well, wait a minute. Annuities are bad, Ryan. Well, wait a minute.
Yeah.
A 15% annuity, fixed annuity, is the same thing as a 15% bank CD.
But as my dad told me, that if something sounds too good to be true, it is. Why would they offer me 15% or even the 7% or 6% that I can find out there right now? So you're saying 15% is a fictional number. That one doesn't exist right now.
No, what
right?
I'm saying is if I had a bank CD that paid 10%.
Oh, yeah, there would be lines around the block.
If I had a fixed annuity paying 15%, which one would you buy?
Well, the logic says you would go for the one of more, but I think people feel safer at the bank option.
And that's
so we hear about FDIC because this is insured over here. But there is an insurance component of annuity as well?
There's a legal reserve system that backs up the insurance industry, just like there is the FDIC backing up the banks, folks. And it's a legal reserve system that says like this. When a bank takes your money in, they can loan your money out up to 10 times, and that's called fractional banking, and that does exist. And Spike and I have this conversation about how the money in your checking account or savings account is literally loaned out to another bank overnight. And this happens every night, by the way, okay? It's called the repo market, all right? And so to that end, the insurance companies cannot take that kind of leverage. So for every dollar they take in, they have to keep $1 in reserve to back up their liabilities, plus they keep a surplus on top of that. So in the event that all the policyholders at the insurance carrier want all their money back at one time, they sell their assets dollar for dollar. If those assets aren't enough money to pay the policyholders back, all right, that legal reserve system requires them to keep a surplus, okay? They keep that surplus. They use that surplus to pay back the policyholders on any deficient asset sales, okay? There wasn't enough money, so to speak, when they sold the assets to pay all the policyholders back. And then if that's not enough, there's a reinsurance system to where each state requires the insurance carriers in that state, if they do business there, they have to proportionately cover each other in the event of a failure based on the amount of fixed annuity sales or fixed index annuity sales they make. So it's a phenomenal system.
All right, but I think most people across America know that FDIC, you've got $250,000 of insurance on it. What about in the annuity and insurance
There's
space?
coverage up to $250,000 per insurance company per carrier, but I understand the FDIC system that backs up the banks is uniquely different. And that's more of a conversation we want to get into one-on-one to kind of better explain it, because it gets a little heady to talk about on television.
So, so you would explain two kinds of annuities. There was the immediate, which you can lose. You step off the curb, you get hit by a bus, does not go to your family. Variable, really high fees. Why would anybody pitch someone a variable annuity to begin with?
Because they earn a commission to sell it.
Okay. So the other annuities, people don't earn commissions?
They do. They do. They earn commissions to sell them, for sure. All right. But you have to look at the features versus the cost of the benefits. Okay. So to that end, if you look at other programs out there, there are programs out there that allow you to have the benefits you can get inside of a variable annuity for little to no cost at all. For instance, there is a death benefit on some of these programs in the form of a fixed index annuity that has little to no fees at all. And the fixed index annuity, which we're talking about now, obviously, there's no cost of an index, right? There's no mutual fund inside the account, okay? And lastly, you can have the features of a guaranteed income for life if you want it, all right? And those guaranteed income life benefits, some have a cost, some have no cost whatsoever. And one of the cool things about some of those benefits is the biggest threat we face is longevity, followed by a long-term care need. Many
That's
of those programs
where
allow you to have doubling of long-term care of payments if you go into a long-term care facility. So,
that's what I want to ask you about, because this is where it started to come into my space. I'm like, the one thing besides having income for life is really worrying today about long-term care. Now, long-term care is a rider inside this. How much are people paying for that option?
On the fixed index annuity space, you have to look at what you're buying the product for, Spike. They do one of two things, and neither one does both things well, okay? So the first thing they can do is safely accumulate money at a rate of 6 to 8% without fees, without risk.
All right.
Okay.
And why would they be willing?
Second thing they can do, we'll get there. Okay. Right. The second thing they can do is they can provide you guaranteed income for life. All right. Those programs will not accumulate money as quickly or efficiently as the ones that don't have the income guarantees. And the ones with the income guarantees and long-term care benefits will typically have a fee. Those fees range between 0.8% and 1.15%, which is still substantially cheaper than the variable annuity, 3.5%.
Or for paying for long-term care insurance on your own on the outside, which can change and go up on you over time.
For sure.
That's why that part has been attractive to me.
That's right. So,
but how often do you see people actually turn on the income?
On the income rider side, according to LIMRA, is very, very few. It's like 5% of the people who pay for the benefits actually use the benefits. So that's what the cool thing about the fixed index annuity space is we have programs that have no cost and no benefits associated with them. And that's what I'm a fan of at Allied Wealth, because you can safely grow money at a rate of return right now between 6 and 8% on average. All right. You can do that with no fees and no risk. And this is really important right now, Spike, okay? Because if people are looking, the Wall Street Journal just had an article out, we talked about it on the radio and the YouTube channel, that says the 60-40 portfolio is melting down. There's no place to hide, all right? Well, guess what, folks? You're in a 60-40 portfolio. That portfolio is down about 22% this year. The average return on that portfolio is 7%. But the portfolio isn't free. You're going to pay an advisor to manage it for you, right?
Even if it's inside your 401k, which I think a lot of people don't realize, you're still paying fees in there.
But yeah, we are. But let's assume we're outside the 401k paying an advisor 1%. Okay. The fund's got to earn 8% a year for you to net out 7 after the advisor's fees. Okay. And to that end, you're getting an average 7% return, but the fund's down 22% this year. Well, are there ways to get an average 7% return every year without paying any fees whatsoever and not being down at all? And the answer is yes. And that's exactly what a fixed index annuity can do for you today.
Too good to be true. Okay. So why, we're going to have to take a very quick break, but why would the company be willing to give me 7 to 8%?
Well, I mean, we'll get there after the break, folks. But listen, I know you've got questions. I know you're sitting here going, these guys are crazy, or whether they're not crazy, or whatever it is, or they're too good to be true. That's why we're offering a copy of the Stress-Free Retirement Book. It is here for you. It's complimentary. We even pay the postage on it, by the way, folks. It's on us, okay? Get a copy of the book. Read through it. It is filled with information. It's a great way to get educated about these programs, all right? And to get it is so easy. All you have to do is call the number on the screen. It's 844-944-7555. You can also click the QR code. That'll take you right to a landing page where you can get a copy of the book as well.
More On the Money with Ryan Wheless, the founder of Allied Wealth. And when you get back after this, call the phone number you see right here to get your own complimentary copy of the book, stress-free retirement. More right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to On the Money with Ryan Wheless. He is the founder of Allied Wealth. I'm your host, Spike Spangle, and we are arguing about annuities today. And he's winning, though. He's winning. I will admit it. But
well, you're just being educated, Spike.
I'll go back to the too good to be true, starting to get it a little bit. By the way, this is a completely unscripted show. I'm not just softballing you questions. These are things I'm really trying to understand myself. So the too good to be true, 7%, I get the idea that I'm loaning them my money for a while, and they can probably make more than 7%. So they're willing to give me this.
Wait a minute. We have to understand something, okay? What's happening is when you put the money with an insurance company, all right, if you put $100,000 with them, they're going to take those dollars and they're going to invest them to earn interest on those dollars. And they're going to pay you a portion of their earnings. They're going to keep a portion of their earnings for themselves. They're going to pay you a portion of the earnings for you, okay? Their earnings that they make for themselves is how they make a profit and why they do this in the first place. All right. Now, as far as the earnings go, they give you an option. You could have those earnings credited to your account in the form of a fixed bucket, a fixed payment. But if you want to, you can take those earnings, just the earnings now, not your principal, okay, not prior year gains, just the earnings from the interest. All right. And they can invest that interest for you into a stock market index using a call option. So you take,
but I'm not buying the calls, and I'm not handling any
They
of
do
this.
it for
They're
you.
taking care of it.
They do it for you. And the goal is to take that interest every year and buy an option on the index, such as the S&P 500. If that index increases in value, that option expands and the interest becomes higher than the fixed interest payment. And that's how you get into the 6 to 8% average return range on these programs.
That's the positive. Let's take a look at this year. The market is down.
The market's down. Well, we say zero is your hero, right? Because people in these programs, the insurance company took that bond interest. The people said, hey, I don't want the fixed payment this year. I want to take some risk in the market. So put my bond interest only, not my principal, not my prior year gains, my bond interest only to work for me, all right? The bond interest, the market falls, so that call option that bond interest purchase is expiring worthless. Okay? So people are going to get zero this year instead of negative 22%. And so their principal and prior year gains are protected from market loss because the only thing being put at risk that each year is that interest payment. They can take it and they can take and keep it, or they can invest it into the market on a call option.
Can you give me the description of a family or a client that would come in where and how much this fits into their portfolio? Let's say somebody comes in, $1 million in savings, house is paid off in a couple of years, they still have a little bit, and they've got their regular expenditures.
Spike,
where does this fit?
Anybody who has a balanced level risk tolerance, which is most people, by the way, so not aggressive, not conservative, in the middle, balanced risk tolerance, which is typically a 60% stock portfolio and a 40% bond portfolio. Anybody who has that right now today is an absolute fit for a fixed index annuity. And here's what I'm saying. The 40% allocated to bonds this year has been crushed.
Down, crushed.
It's why it's on the Wall Street Journal cover page saying that the 60-40 portfolio is drowning. There's no place to hide this year, okay? Take the bond portion that's getting crushed right now because the Fed is raising rates. Folks, when interest rates go up, bond values go down. Go to the YouTube channel, On the Money, Ryan Wheless, YouTube that. There's a whole video on it, how we explain that, okay? But bond values go down. And when bond values fall, your portfolio falls. If you replace your bond portion of your portfolio with a fixed index annuity, you shift the risk of loss due to rising interest rates to an insurance carrier, and you can still average somewhere between a 6 and 8% return per year, which is pretty awesome.
If this is so good, if this is a reliable way to be diversified, then why don't we have these options inside our retirement accounts at work? The only two things we have in there are stocks or stock funds, bonds or bond funds, or those target date funds. Why don't we see annuities in there?
It's being pushed right now, Spike, and we believe it's actually going to happen under the Secure Act 2.0. It's being legislated right now. Now, the legislature session will end here this year. We'll have kind of the lame duck session, right? We don't think it comes out until January or February or March of next year, but it is being worked on. It is being talked about, and it should be there. I worked with a lady recently who rolled her old 401k into a new 401k at work, right? And she had $700,000 in January of this year. She's down to $500,000. And I got to her and said, listen, did you know you could have rolled this money over to an IRA and not into your new 401k? She said, no, I had no idea. Okay. And did you know that could have put you in a program that would have protected your $700,000 from loss and probably average you a 6 to 8% return going through time?
And it sounds like this person is still working.
She is.
So the biggest thing is the illiquidity that people talk about, but that's a longer conversation. So she wouldn't be able to access that money anyways because she was still working.
Spike, illiquidity is not an issue. You have access to 10% of your account value every year without penalty whatsoever. And folks, I've got news for you. If you're spending your retirement savings down at 10% a year, you're 12 years from going broke. It's that simple.
Right.
So 10% should be enough. But you make sure it's enough because you don't allocate so much money to an annuity to where a 10% would.
You got 30 seconds to tell them about a stress-free retirement.
Folks, listen, I know we're talking about this stuff. It's a complicated subject, complex subject, a lot to cover in a very short period of time. That's why we're offering the stress-free retirement book to you today, complimentary. I even pay the postage, folks. To get it, all you got to do is call the number on the screen, 844-944-7555. You can click the QR code as well, and we'll ship you out a copy.
Thank you so much for watching On the Money. We'll be back again next week. Call for the complimentary copy of the Stress-Free Retirement.